Hello everyone. In this video I'm going to walk through the notes for the weighted average cost of capital that are out on D2L for you. My strategy with this topic is to go through the notes first, and then I'm going to work through an example, and I'll do that for next week's class. So for next week's class I'm going to walk through an example on how to calculate this for an individual firm and work through an example of that, and then your assignment is going to be then to go and I'll give you a firm, and you'll need to calculate the weighted average cost of capital for that firm, and I'll give you the materials you need in order to do that. So I want to start off a little bit talking about what this term means, the weighted average cost of capital. I'm going to add some notes in here. So remember that capital, we defined capital earlier on in the course as capital is the amount of investor supplied funds. And so when we're looking at a company, investors supply funds in the forms of either purchasing the debt of the firm, so it's bonds, or a bank could be seen as an investor in a company because they purchase the debt, they own the debt of the company, so they get returns from that. And also stocks. So a company has an IPO, an initial public offering, and they go out and they sell stocks to investors, and so those investors in turn, in exchange for receiving those stocks, pay the company money and so provide funds to the firm. So capital is the amount of investor supplied funds. The weighted average cost of capital, and we're going to abbreviate that as WACC, is the discount rate at which the cash flows of the firm or the cash flows of the project are discounted back to today to determine its value. It is the weighted average of the required rates of return for investors, stockholders, preferred stockholders, and debt holders of the firm. So those debt holders are going to be those bondholders or the lenders of the firm. So the weighted average cost of capital is the required rates of return for the investors. So these are the required rates of return that the investors have for their investment into the firm. The weighted average cost of capital is also known as a hurdle rate. And I will link to a video. I usually like to show this during class of people running hurdles, and because so a few years ago I said this in this course. I talked about it being a hurdle rate, and I had a student come to me after class and say, I didn't really, and she said, I don't think the rest of the class really understood what you meant by the term hurdle rate. And so, we talked about it, and I said, you know how people run hurdles, in track. I said, it's the same idea. This is the rate at which, whenever a company looks at investing into a project, this is the rate they have to clear. So the required rate of return is the required rate of return for the firm's projects, the minimum required rate of return. So it's a hurdle. They have to jump over it. And so I have a video, actually I don't have a video, I have a link to a video on YouTube where people are trying to jump over hurdles, and sometimes they fail, and I find it funny. I'll provide a link in D2L for that. But it is a hurdle rate for the firm's investments. So later on in the course, we're going to go into two topics where we use the weighted average cost of capital. We're going to talk about capital budgeting, and we're also going to talk about valuation. So I mentioned valuation down here. We're going to take the cash flows or the expected cash flows of the firm and discount them back at the weighted average cost of capital to determine the value of the firm today. And then with capital budgeting, we set the weighted average cost of capital as the required rate of return. So if a project is not expected to earn back that weighted average cost of capital, we would reject it. And so that is why it's a hurdle rate. Okay. So I'm going to start off by going through this equation here, which is the equation for calculating the weighted average cost of capital, explaining what each of the components are, and then the rest of these notes go through how we calculate these values. The notation may be different than what you've seen in the past. In financial literature and accounting literature, the cost of capital the capital components, are sometimes referenced as a K and sometimes as an R. There is, unless the text that you're using or the instructor that you have indicates otherwise, they mean the same thing. Okay? K and R are essentially interchangeable. So K sub D is the required rate of return on the firm's debt. Oops. Sorry about that. Firm's debt. It's also known as the cost of debt. And sometimes we'll also see it as R sub D. Oops, not what I wanted to do. There we go. We'll also see it as R sub D. Okay. One thing I want you to know when you hear the term cost of, so cost of capital, cost of debt, cost of equity, these are not dollar cost. Okay. When we talk about these costs, we're talking about percentage, required rates of return. I'll often say cost of debt because it's the easiest thing to say. It takes a lot less time to say cost of debt than required rate of return on the firm's debt. So, but they're all interchangeable. They mean the same thing. And again, remember, we're talking about percentages, or the way we calculate it, we'll often use decimals, but we're not talking about dollar amounts. K sub S is the required rate of return on the firm's common equity. And we'll differentiate between common equity and preferred equity. Preferred equity, as we'll talk about later, is less risky than a firm's common equity. And so we need to differentiate that out. There are two sources of equity. This is also known as the cost of equity. You'll also see it denoted as R sub S, or the required, I apologize. I set it up here kind of twice, didn't I? Required rate of return on the firm's on equity. If we don't, or if I don't, differentiate and say common equity or preferred equity, what I'm talking about then is just common equity. Most firms don't have preferred stock or common stock, or excuse me, preferred stock or preferred equity. When we get to that portion, I will describe why that is. Okay, so this is the required rate of return on the firm's preferred stock or preferred equity. So that PS stands for preferred stock. And again, I'm putting a few of the terms out here. You'll also hear K sub S and K sub PS referred to as the cost of preferred stock or the cost of common stock or the cost of stock. It's a little more rare on that last one. There we go. And those are the the capital components and how we denote their cost. And again, all of these are required rates of return. So we would see them displayed as either a decimal form or in percentage form. Weights are the weights of the capital components. And these are usually denoted using a decimal. Again, they're not a dollar amount. So up above in the formula, you've got W sub D, that's the weight of debt. W sub PS, that's the weight of preferred stock. And W sub S is the weight of common equity or common stock. The sum of the weights must equal to 1. Okay. So if you had 50% of your capital provided to the firm is in debt and 50% is in common equity, W sub D would be equal to 0.5, W sub S would be equal to 0.5, and then the sum of those together would be 1. And we're going to work an example of this in the class. So T is the marginal tax rate, income tax rate for the firm. Or I'm sorry, I shouldn't say marginal. We're going to actually use the effective tax rate for the firm. So up here we got 1 minus T. We have 1 minus T, and I'll explain this in more detail later, but we multiply the required rate of return on debt by 1 minus T because the interest for the firm on its debt is tax deductible. Returns for capital components are commensurate with the risk of the components in order to induce investors to make their investments. One thing I want you to know for certain here is that K sub D must be less than K sub S. Okay. Okay. This has to be true for a given firm. So for example, if we're looking at Walmart and we see that their required rate of return on their bonds is about 3%, that means the required rate of return on their equity has to be greater than 3%. And the reason being is that debt holders have a priority to the income and assets of the firm over stockholders. Okay. I mean, they get paid first. So with income, debt holders, and that would include, in this class we're usually going to be talking in terms of bonds and bondholders, but it also includes banks. So the banks, the lenders, the debt holders, get paid out of the firm's income before the stockholders get anything. And this isn't necessarily in terms of a timing issue, this is in terms of the priority. If the firm doesn't pay its debt holders the required interest and the required principal payments, then the firm will go into bankruptcy, or they'll have their, if the debts are have specific collateral attached to them. So think about if you have a car loan, you have to, the lender puts a lien on that title of that car. If you don't make the car payments, they come and take your car. Okay? So if the business doesn't make its debt payments, the business will either lose its ability to operate as it has in the past, or it'll lose some of its assets. So they have to get paid first. Those debt holders have to get paid first. And so secondly, we talk about the priority to assets. in liquidation, so if the company does go bankrupt and they file for Chapter 7, and we're going to get into those. If you're not familiar with Chapter 7 and Chapter 11 bankruptcies, we're going to talk about those later on when we talk about specifically about debt a little bit. So in liquidation, debt holders are paid back prior to equity holders receiving anything. Okay. And for some reason, Word doesn't like the term equity holders, but I'm just going to leave it. It's the same as stockholders. Common stockholders I apologize. I'm having a formatting thing there. There we go. Common stockholders are referred to as residual claimants, meaning they get the leftovers. Okay, they get the leftovers if the company goes through bankruptcy, if they're liquidated and all of the assets of the firm are sold for cash. After everyone else gets paid off, the lawyers and accountants are going to get their money up front. The government is going to make them the firm repay any back taxes that they owe. The employees will hopefully all get paid as well, anything they're owed. The debt holders, the bond holders, the banks, they're going to get paid off. If there's any preferred stock out there, they're going to receive their par value for that stock, for that preferred stock. And then if there's anything left over, and typically in liquidation, there's not. Okay, there's not anything left over. In fact, you usually don't get all the way down that list. But if there's anything left over at liquidation, that's going to go to the common stockholders. So they are the residual claimants. They get whatever's left over. They face, in this case, between debt holders and stockholders or equity holders, the stockholders face the most risk because they're last in line for income, last in line for assets, for cash from asset liquidation. As a result of this priority to income, priority to assets for the debt holders, the debt is less risky for a given firm than it is than the stock is for the investors of the firm. So as a result, debt holders, the required rate of return on debt should always be less than the required rate of return for equity. It doesn't mean the realized returns will always be less for bondholders than for stockholders, but it does mean that the expected amounts should be less. Otherwise, if I'm not going to take on more risk as a stockholder expecting a lower return than what a bondholder is going to get. Okay. I hope that makes sense. I focus on this point because several years ago, I was a teaching assistant to the person who taught this topic at University of Arkansas for their graduate program, and he didn't tell his students this. And I was grading their projects, and the way they calculated, and I'm going to show you this method along with others, the way they calculated the required rate of return on equity gave them a result that was less than the required rate of return for debt. And I went through and I marked them all wrong. And he didn't like that very much because he hadn't shown them, he hadn't explained this to them. And then I wasn't his teaching assistant for much longer, which I was glad about because we didn't get along the best. So anyway, that's a little too much information there, but I thought I would explain why I go into so much detail. It's because this is one of those things in finance where, a lot of times it's up to interpretation or it depends on the situation. This doesn't. So for a firm, the required rate of return for debt should always be less than the required rate of return for the firm's equity. Okay. The cost of debt is usually estimated by using the yield to maturity on outstanding bonds. Usually what I like to use the yield to maturity on the firm's 10-year bonds, meaning that they have 10 years left until the maturity date. I use that, and I see it commonly used because when we talk about things like projects for a firm, that's a good timeline for about, the length of a large project for a firm is 10 years. Sometimes we don't have that information for a firm, so we can also use an estimate for the yield to maturity based on the bond rating for the firm and the time to maturity. So let's say a company has a 1-year bond out there, but they have a bond rating of AA. Well, we can actually look up the the average yield to maturity for firms that have a AA rating and see what it is for a 10-year time to maturity. We can also have companies that have no outstanding bonds. They're required, their debts, if they have any, might be just bank debt. We can estimate the yield to the bond rating for those firms. That's a separate process, but we can actually go out and estimate what that would be and what the required rate of return on their debt would be if they did have debt. If they just have bank debt, again, we could figure out what the market rate of return would be, or we can actually look up in their financial statements, the notes to their financial statements, and see the interest rate they're currently paying. And that's a little more detail than we're going to go into in this topic in this class, but it is how you would do that if you were wondering how we would calculate that if the firm didn't have any bonds outstanding. So I'm just going to go out here. I love Capital IQ. I mentioned it in the last video. You have access to it if you want it. I'm happy to help you get access to it if you desire that. And I'm just going to look up a company here and show you their bonds. So let's see. In the last video, I talked about Nike, so I'm going to go ahead and pull up Nike here. So this is the what's referred to as the tear sheet for Nike. I'm going to go out here to, it's down below, it's under fixed income. So the reason why we refer to as debt as fixed income is because as an investor, the cash flows that I receive from the debt of a firm are fixed, usually. If I buy a bond, it's got a set coupon rate that determines what the coupon payment will be, and in most cases that payment does not fluctuate. And then at maturity, I receive the principal value of the bond, and again, that value generally does not fluctuate. It doesn't change unless there's something special about the bond, a characteristic about the bond that's different. Okay, so I'm looking at here under fixed income, and it's got summary. I'm going to pull this up. There's a number on there and when I go through next week and work through an example of a firm, I'll show you this. I'll use this information to calculate returns. Now this is odd and a little bothersome for me right now. So we have the benchmark securities. The maturity date for one of those is November 1st, 2026. The maturity date for the other one is March 2030. So they usually go 5 and 10 years for those maturities. Now this is odd here. There should be a yield. So I talk about the yield to maturity. What Capital IQ provides is called the YTW, or the yield to worst. And this is actually referring to the fact that you can have bonds that are callable. And with a callable bond, you might have a different yield to maturity So what they give you here is the lowest yield to maturity for what that bond is. Now here we don't have any, which is again a little bothersome because we'd like to see that there. So I don't know why that's not available out there. I've just pulled up the information about the security itself. What I'm going to do is go back here and I'll show you how to look up all the bonds for the firm. We can see that they have a double an AA negative rating out there, which is a high rating. It's an investment quality bond. So I'm going to go back to fixed income down here. I'm going to click on security summary. So this is going to give me all the bonds outstanding for the firm. And so you've got this weird thing here, and I don't know why, and maybe I should have picked a different company. But they're not showing any yields on any of these bonds. So that's a little weird. But here we do have one that has a yield of 2.65%. I'm going to look up one other company here. I'm going to go to Walmart because I know they have a slew of bonds out there. And that, again, was a little strange. So, again, I went to Walmart. I'm going to go to the fixed income summary. There we go. All right. So this is really weird looking. You've got your 5-year maturity. You've got your about 10-year maturity. The yield to worst on the 5-year maturity is negative. So again, kind of very strange. And then we wouldn't necessarily want to buy a bond that provides a negative return. And then the 10-year bond for Walmart provides a 1% return, which again is extremely low. I'm going to go out here to the security summary again. They have a AA credit rating. And we can see here their yields are extraordinarily low. And they have many, many securities. So this is just the first 25. You see out here, the longer the time to maturity, the higher that yield is. Their highest one in this list is this one that matures in October of 2043 at 3%. Here in the middle is this seniority. So senior unsecured. This means that the bond is not subordinate to another bond. You can have junior bonds out there that get paid after the senior bonds get paid. Unsecured meaning, and you can see all of Walmart's bonds are unsecured. It doesn't mean that there's no security. It means there's no specific collateral. So oftentimes with bonds, if they have any collateral, it's going to be a mortgage. So it might be a mortgage on a building, might be a mortgage on land, but it's secured oftentimes with real estate if they're going to have security. Most corporate bonds do not. Okay, so when we see the term corporate debenture, that's generally an unsecured bond. And we've got foreign currency debentures here. So those are just bonds in foreign currencies, which we don't really get into in this class, but it is a type of security that's out there. Anyway, that's kind of to give you a little idea of what we're talking about when we talk about yield to maturity. So what the term yield to maturity means, it's the return that an investor will receive if they hold on to the bond until the maturity date. As long as the firm does not default on the bond. In other words, as long as the firm makes the payments as agreed and they pay that principal as agreed on the maturity date, then your yield to maturity is the return you're going to achieve on that bond. So for example, if you purchase a Walmart corporate bond with 20 years to maturity and a 2.5% yield to maturity, and this is key here, at the time when you purchase the bond, then if you hold the bond until maturity, your annual return on the bond will be 2.5%. Okay. So the reason for that is you're going to buy the bond at a price that's set to give you a 2.5% return. What changes about a bond? So I mentioned before that the coupon payments don't change unless it's a special kind of bond. Okay. The principal at maturity doesn't change, so the cash flows for the bond don't change. The time to maturity doesn't change. So all those things are things that don't change about the bond. However, in the marketplace, the required rate of return of that bond will change based on market conditions. So if interest rates go up, okay, then the required rates of return on bonds also increase. So that yield to maturity is the required rate of return. So when that goes up, the value of the bonds, the price of the bonds go down. Okay? If the required rate of return goes down, the price of the bond goes up. So what's happening out in the marketplace is that required rate of return on the bond is changing based on market conditions and conditions concerning the company. So if next week a big scandal about Walmart comes out and it threatens, their continued existence, okay, the required rate of return on their bonds is going to go way up because their bond ratings will drop. Okay, they'll be seen as a riskier company, and so the yield to maturity will increase. Now, if I purchased that bond 2 months ago, before all the wild stuff started happening with Walmart, and it's all made up, but in my yield to maturity was 2.5%, as long as they don't default on those bonds, and I hold it till maturity, my return doesn't change. Okay, it's only if I sell early does my return change. I hope that makes sense. Let me know if it doesn't. So that's where we get, that's what the yield to maturity is. Again, on Capital IQ, they have YTW, and where that yield to worst would come in, again, an example of that is if the bond was callable. What a callable bond is a bond for which the issuer, so in this example I was saying Walmart, could tell the investor, we're going to buy your bond back early, and with a callable bond there's a call price. So when you buy the bond, you're aware that it's a callable bond. You're aware that there's a call price, and that call price is set, kind of like the principal value at maturity is set, and it provides a premium to the face value of the bonds, or what you would get at maturity. So let's say that for this Walmart bond, the call value might be $1,025 rather than $1,000 you'd receive at maturity. So you're getting the face value plus a little bit extra for it being called early. So your yield to call would be different than your yield to maturity, and as a result, the yield to worst would be the lower of the two. That's not terribly important information, but I did want to explain what the difference between the two are. The tax rate is deducted from the cost of debt because the interest paid on debt is a deductible expense for tax purposes. So if you itemize your taxes, you get to deduct your mortgage interest off of for tax purposes, on personal income taxes. If you have school loans, you get to deduct up to $2,500 a year of interest on your school loans for tax purposes. So it works the same way for a business, except for you get to deduct all the interest for tax purposes for a business. And the result of that is that it creates what's called a debt tax shield, and that reduces the actual realized interest you're paying out. So, for example, if I had a mortgage on my house and I paid interest at 4%, let's say my interest rate is 4%, Well, but if I get to deduct that interest for tax purposes, so I don't pay taxes on the income I paid out on those interest payments, then my effective interest rate on that would be the rate of interest multiplied by 1 minus the tax rate that I get to avoid. So let's say, trying to come up with an easy way to do this in my head. Let's say my tax rate is 40%. So I pay 4% on the debt and my tax rate is 40%. So my effective tax rate is going to be 2.6%. And let me just work this out for you. So my interest rate is equal to 4%. My tax rate is equal to 40%. So my after-tax cost of debt is equal to 0.04. That 4% multiplied by 1 minus 0.4, the 40%, would be equal to 0.4 times 0.6, or 0.024, or 2.4%. Okay. So having that debt tax shield can really lower the cost, the required rate of return for a firm's debt that the company's paying out. All right. Excuse me. The next, and so that kind of wraps up the cost of debt, probably the easiest one other than the cost of preferred stock to calculate the cost of. The cost of preferred stock is estimated based on the stated dividend and the price for the preferred stock. Flotation costs are also included because any new funding from preferred stock has to come from the issuance of additional shares. That's not true for common stock, and that's why we don't use flotation costs usually for common stock. Okay, so anytime a company wants to get additional money from preferred stockholders, they have to make a new issuance of preferred stock. In 2010, in kind of a famous example, Warren Buffett was issued preferred stock from Bank of America. It was a huge deal at the time. We were going through, the financial crisis. Banks were shutting down. Bank of America needed some capital. They needed some equity for regulatory reasons. And they struck a deal with Warren Buffett because people, investors especially, tend to respect Warren Buffett and agree, like what he does. And so when Warren Buffett purchased preferred stock from Bank of America, that was kind of a stamp of approval from Warren Buffett saying that this bank is safe, okay, for investors. And so they issued him his own preferred stock. The way the preferred stock works is it's usually quoted. The quote for it usually includes in the name for the issuance the return. So I believe his was, I'm probably going to get this wrong. Ones I've seen out there, I'll just say, ones I've seen out there, we'll say 6% preferred stock, okay? Meaning that the dividend is set based on providing the investor a 6% return. Okay? So a little different than common stock. The cost of preferred stock is estimated based on the stated dividend and the price for the preferred stock. Flotation costs are also included. Our DPS up here is set. Okay, so the dividends per share, and that doesn't stand for per share. It just means dividends for preferred stock. Unlike for common stock, the dividend is a set dollar amount. And when I go through and I work an example, I'm going to work a separate example for the required rate of return on preferred stock, because for a lot of, or preferred equity, for a lot of firms, they just don't issue it. So DPS is the stated dividend for preferred stock. Unlike for common stock, the dividend is a set dollar amount, and it does not change. It's a set amount and it does not change. So for Warren Buffett's, his might be $6 a share. Okay. And next year it's going to be $6 a share, and the year after that it's still $6 a share. It doesn't go up, doesn't go down. That's not true. This is not true for common stock. This is not true for common stock. Dividends for common stock increase and decrease all the time. They go away, they come back. So it's a set dollar amount. We're going to talk about more about that later. And let me change something here. I made that uppercase. Doesn't really matter, but just to be consistent, I'm going to make that lowercase. PPS is the current price of the preferred stock on the market. That's what it's trading for. So when the required rate of return changes for preferred stock, that's going to change the price. Then finally, F is the flotation cost as a percent of the proceeds received by the issuing firm when the preferred stock is issued. So if a firm issues $1 million in preferred stock and their flotation cost, so these are going to be the cost of actually issuing the stock, going through an investment bank, working through those functions, getting the stock out in the marketplace, paying the lawyers, paying the accountants, getting everyone paid that needs to get paid. Those are the flotation costs. Okay, that's the cost of actually issuing the stock. So we're going to take that out of the proceeds, what we, per share in this case, of each stock that was put out there, and then our required rate of return, or our cost of that capital piece, is going to be the dividend, the set dividend, divided by the price multiplied by 1 minus the flotation cost. So what's left over after we pay for those flotation costs. Okay. We do that because, again, the firm doesn't receive new income from that source of capital after the issuance. So they go out, they sell the stock, they receive cash at that point, but then they don't get any more. Okay. They don't get any more from preferred stock. That's not true with common stock. So again, when I go through and I'm going to work the big example for next week's class, we'll look at preferred stock separately as a separate example there, and I'll show you how that gets calculated. So the big one here is the cost of common stock. The cost of common stock is typically calculated without including flotation costs because the main source of common equity financing is retained earnings. Retained earnings are earnings that belong to the common shareholders or the common stockholders, but have been reinvested back into the firm. So the way that common stock works is that usually when a company is young, it's been operating sometimes for a few years, and it decides, the owners and the managers decide that they need to bring in more capital. They need to bring in more investment. And that might be to pay off the original investors, or it might be that the firm needs to grow and they need more money in order to grow. And so they're going to sell stock in the public markets through initially what's called an IPO, or an initial public offering. And they're going to receive cash. So the company receives cash at that point from the investor. And that's the only time they directly receive cash from the investor, where the stockholders give cash to the company. Okay? That's important to remember. Stockholders aren't continually putting in more new cash for a publicly traded firm, unless the firm is issuing new shares, and we're going to talk about why firms rarely issue a significant number of new shares later on in this lecture. But in general, this is the point, okay, where the company receives cash from investors. Beyond that, though, as the company earns money, okay, they generate a profit, they don't pay those earnings out as dividends, they retain them within the firm. That money is also, in a way, supplied by those equity investors, because that money really belongs to those equity investors. So retained earnings are income, or let me say it better, is income. It seems so weird to say is there. Is income that is not paid out to investors as dividends. If you think back to that tutorial we did for the lemonade stand, after we paid off our bondholders or our debt holders, we paid their interest for that time period. So that investor class has been paid off. Then we would start paying the preferred dividends if we had a preferred stockholder. Okay, we'd pay out the preferred dividends then, because those preferred dividends are required. It's not something where you can typically hold off on and say, oh, we're not going to pay them this year, we want to reinvest. They're a required payment in most cases, contractually required. After that, then, whatever's money is left over can then be paid out to stockholders, but often isn't, especially when the company's really young. They're retaining that money. They're saying, okay, we have a profit of $500,000 this year. We really could use another building, or we could really use another line, a manufacturing line or something. There's something we could justifiably take that money and use it for. So instead of paying it back out to the stockholders, they're going to retain that money into the firm. So those retained earnings really belong to the common stockholders. And I put, at least in theory, because there's a lot of situations where companies don't always do the best thing with that money that they could be paying out. So the reason why we estimate the cost of retained earnings is because that's money that really belongs to the stockholders. And in order to justify using those funds for investment, the firm needs to earn the required rate of return by the common stockholders on that investment. Okay. Let me give you an example of this. I used to work for a privately held firm. So I worked for two banks. I worked for a Bank of America, very, very large bank, publicly traded bank, millions and millions of stockholders. Then I worked after that for a privately held bank called Arvest Bank, who had one primary stockholder. He owned 97% of the equity in the firm, and the little tiny bits that he didn't own was owned by managers that he sold investment to. Well, and I shouldn't just say managers, employees in general. I was an employee and an officer of the bank, and I was given the option of buying stock in the bank, and he was the market. Okay, his name was Jim Walton, son of Sam Walton. Super nice guy. Came in and talked to me. I was about a year out of college, a year and a half-ish out of college when I started working there. And I was, we all had to be door greeters. So everyone up to the president of the bank had scheduled times to stand at the door and greet people as they came in. And, it was short shifts where we'd go up for 15 or 20 minutes and stand by the door and greet people and say hi and everything. So, well, one day when I was standing up there, not long after I started working there, here comes this guy with a bowl haircut on, and his name badge, because we had name badges that said our first and last name, his just said Jim. Okay, super nice guy. Stood and talked to me for about 15 minutes that day. And I talked to him a few times here and there as I worked for that bank. Anyway, he was the kind of the sole owner of the bank, and so it was easy to determine what the required rate of return was. He told us. He said, my required rate of return is 15%. And that's so easy. You know, if we could only know what the required rates of return for the investors in a firm stock are, it wouldn't be so difficult, as you'll see, to determine, to kind of guess or estimate what that value is. Unfortunately, when you talk about a company like Walmart or Amazon or Apple or Microsoft, where they have millions and millions of stockholders, we can't go through and interview each stockholder and say, what's your required rate of return for this stock? We have to look at the marketplace. We have to do some calculations and estimates to try to get to that number that is the accurate required rate of return for those investors. I mentioned before that firms avoid issuing new equity, and they do this for three reasons. The first one is that it's expensive. Flotation cost that I mentioned for preferred stock, flotation costs are high. They're higher than preferred stock because preferred stock is generally a pretty straightforward security. You issue you say the dividend will be this amount, and pricing just follows that pretty easily. With regular common stock, there are no set dividends, and in fact, very few. And I'm actually doing a study that's related to this right now. I don't know of any stocks that have an IPO and start paying a dividend right after that. It's just extraordinarily rare. So we don't know what the cash flows are going to be from that company. So it's difficult to price. Okay? So it's expensive to issue new equity. Flotation costs are high. The second issue is that new equity issues dilute the control that existing stockholders have. Existing stockholders do have what's referred to as a preemptive right. To purchase newly issued shares in order to maintain their ownership percentage. However, this requires additional investment by those investors, and oftentimes they don't want to do that. They own, their exposure to that firm is what they want it to be already. And so if the firm goes out, the way this preemptive right works, let's say that I own 10% of a firm, okay? So 10% of a firm's stock. So that gives me control, a certain amount of control over the, who's on the board of directors and major decisions about the firm. So if the company goes out and decides to issue 2,000 additional shares, I have a preemptive right to maintain my control, my level of ownership of that firm. So if I own 10% and they issue 2,000 shares, I have a preemptive right to purchase 200 shares. Okay? And so that will allow me to maintain my level of existing control over the firm. However, as a stockholder, it kind of ticked me off if, they said, we're issuing new shares. If you want to maintain your ownership, you need to buy more shares. Okay. So again, a reason why that firms don't issue new shares. If I don't purchase new shares, then I lose some of my control. So it dilutes my control of the existing shareholders for me if I own shares of that stock. The third reason is it sends a negative message about the value of the stock, the firm's stock price. It indicates that the current stock price of the firm is too high. In other words, the stock is overvalued. So let me give you an example of why issuing new shares might indicate that the value of the firm is overvalued. I'm going to talk about a car called the Geo Metro. Some of you may be familiar with the Geo Metro. Some of you may have driven a Geo Metro. It is unlikely any of you are still currently driving a Geo Metro. They were stopped being produced in 2001. Not the greatest car ever. Looks like this. This is the coupe model. There was also a two-door model. Let's see if they have it on the page here. Yes, they do. This would be the two-door model. Little death trap. So, as you can see here, it's a tiny little car, and it's a cheap little car. But I want to say it would have been 2008, 2007, 2008, gas prices started getting really high, $3-4 a gallon. And these little tiny cars, they were clearly used. They stopped building them in 2001, but they started going for several $1,000s each at that time. Okay. And so, if you owned a Geo Metro, it's a great time to sell, because clearly this little car probably wasn't worth that much. But they were selling for so high because people wanted a car that didn't use much gas. And I believe many of these vehicles were actually 3-cylinder cars. You got your standard 4-cylinder car, which has a very small and weak motor in it. But these were even weaker and smaller and used very little gas. So as a result, it was a poor man's version of a Prius that did not rely on a battery. Okay, it just used very little gas. So the value of those cars got really high. Okay, so the idea here is that if you've got an asset or an investment out there that's selling for much more than it's really worth, then you're going to want to sell more of it if you own it. So if I owned, I'm trying to think of something that's been big in the past. There'd been Pokemon cards. My son's got a bunch of those from years ago. And if they went really, for really high prices, he'd be out selling them. Okay, because he likes money and likes to make money, and so as a result, if the cards are selling for a lot, he's going to sell them because they're selling for more than what they're worth to him. Okay, this little Geo Metro was selling for a lot because of market situations that were temporary, and so people that had them were out there selling them like crazy because they knew they really weren't worth that much, or I would assume that they knew that they weren't worth that much. So whenever a company goes and issues new stock, after the IPO has occurred, if they're issuing a lot of new stock, what they're indicating is that if they're able to sell it at the market value, that it's not worth that much, because otherwise, if it were undervalued, which is usually what companies try to indicate about their stocks, that it's really worth more than what it's selling for in the market, they wouldn't sell extra shares at that price. They wouldn't sell extra shares at that price. It's only if it's overvalued, if it's worth less than what it's being sold in the market, would they issue new shares. Now, this became an issue recently, if you remember, about GameStop. Well, one of the other companies that were subject to that short squeeze was AMC Theaters. Their stock price went up quite a bit during that short squeeze push, and during that time they issued new shares, which was kind of seen as a not very nice thing to do. Let me just show you this really quick. So again, AMC was one of those stocks that got followed by Wall Street bets. And you can see what happened here. This was the short squeeze where the company stock price got pushed way up. So what was going on is that, you know, before all this, it was selling for around $2 a share. Then it started going up. The managers and the executives at AMC knew it wasn't worth that much. That's been one of the theaters that have been really hard hit by the pandemic. People aren't going to the movies, they're not generating income, and so on. You can see their earnings per share for the last 12 months were negative $34, almost negative $35 per share. Not a good sign for this company. So a lot of hedge funds had short sold the stock, betting on the stock to go down in price. Well, you know, the short squeeze resulted in this price jumping here. So what happened here is about where they were at about $4.50 a share, so more than double what their low was around here. AMC decided this is a good time to issue new shares. So they went out and sold additional shares to the marketplace. And a lot of people came out and said this really wasn't a good thing for the company to do, because they're really taking advantage of investors who are now their investors by selling them a stock that isn't worth as much as isn't worth the price of $4.50 a share. They could have done much worse, though. They could have issued up here at almost $20 a share. That was a great time to sell, not a good time to buy. Okay. So I've kind of gone on that topic, but whenever a company issues new shares, it's indicating that the market price is more than what it should be. And so that's why companies tend to avoid doing that, because it'll hurt their existing shareholders. So for those reasons, we don't include flotation cost in the required rate of return, calculating that required rate of return. There are many methods for estimating the cost of equity or the required rate of return on equity. I used to teach a class purely on equity valuation. We would spend over a month in that class on this one topic. I'm going to show you two general approaches. The discounted cash flow approach, and then the capital asset pricing model is one of a group of methods where we use regressions to determine the relationship between the firm's returns and, in general, macroeconomic variables, but also sometimes some firm-specific variables. I'm showing you the kind of the granddaddy of them all, the capital asset pricing model, where we only have one variable, and that's market risk. But new methods of this have actually gotten a lot better, and they show different risks, but it's a little too complicated for this class to go into those. But I wanted to show you examples of both. So the first one we're going to talk about is the discounted cash flow approach, also known as DCF. In this case, the required rate of return on equity is equal to the dividend yield, which is D1 over P0, plus an expected growth rate for the price of the stock. Okay. So let me put in here really quick what this first item means, because I don't have it described below. So this is the dividend yield for the stock. D sub 1 is the expected dividend for the next year, and P sub 0 is the market price of the stock today. The idea behind this is that's the amount of return I'm going to get from the dividend in the next year. And then the expected growth rate is the growth rate in the price of the stock that I expect to have over the next year. So it's the percentage increase in the price of the stock for the next year. This is also known as the capital gains yield. So if you've heard of the term capital gains, that's whenever you own an investment and the value of that investment increases over the time period. This is the yield, and it's calculated as there we go. I'm going to insert an equation here. New equation. All right. So K sub S is equal to, or I'm sorry, start with the capital gains yield. Is equal to P sub 1, so the price at time 1, minus the price at time 0, divided by the price at time 0. Oops, let me. Okay. So as a result, I'm going to take this formula here. I'm going to change one thing about it. The required rate of return on equity for a firm is equal to its dividend plus, oops, there we go, plus, in parentheses, the P1 minus the P0. Divided by P, and we're going to take off that expected growth rate because that is included in the numerator now. Okay. But the idea here is that we divide up the return for the stock between the dividend yield and the capital gains yield. Okay? And these are expected values because when we see 1, that means the next time period. So the price a year from now is P sub 1. And then I'll put down, because I've got D1 and P0 up here, I'll just go ahead and put the same thing up here. I'll put P sub 1 is the expected price 1 year from now. Okay. So the the dividend yield is usually actually provided when you look up the information about the company. So you know, we can usually estimate pretty well what the dividends for a firm is going to be in the future, and this is often done by analysts, where they're, you know, they've looked at the history of dividends, they've investigated the company, and they've determined what the expected dividend is for the next year, and they're going to divide that by the price today. And then the same thing is going to happen with the capital gains yield. We're going to determine what the expected price is a year from now subtract out the current price, and then divide by the current price to get that capital gains yield. So the D1 over P0 is easy to determine. It's commonly provided. The one that's difficult is that capital gains yield, or that expected growth rate. Okay. There's three methods I'm going to show you. The first one is the historic growth rate, and this is the historic growth rate in dividends. For a mature firm, that has a stable dividend growth rate, so this is the percentage by which the dividend dollar amount grows every year. The growth rate in dividends is equal to the growth rate in the price of the stock. So the capital gains, the price of that stock should grow by the same rate at which the dividends grow at. Now this is, the small subset of firms where this is going to work for. So a company that doesn't pay dividends, like a Tesla, they don't have a historic growth rate, so you can't use it here. For a younger company that pays dividends but is still in kind of that growth phase, their dividend growth rate might be really high, and so we wouldn't want to use that as the capital gains growth rate because it's not a stable growth rate yet. This is nice for a firm that has a stable, has been around a long time. So you might think of, although it doesn't really work, and might use this as the example actually, Coca-Cola has been around a long time. They're a mature company. They actually have historically, in the past 10 years or so, have actually had a pretty high dividend growth rate, but that's because of things that are going on with Coca-Cola. But you think of McDonald's. I love to use, and I don't know, I don't have it in front of me right now. Some of you may work there. Capital Federal is an interesting study on dividends because they're very unique in how they pay out their dividends. But this might also work very well for them. The retention growth method. So there is a maximum sustainable growth rate for a firm. So sustainable meaning that they will be able to continue to grow the dividend, or excuse me, not the dividend of the firm, but to grow the firm at a sustainable rate in the future. This method assumes no change to the capital structure. So using the capital structure that the firm currently has, we can estimate a maximum growth rate. The formula is okay, here we go. I'm going to insert the formula here as an equation. Is that the growth rate is equal to the return on equity for the firm multiplied by 1 minus B. Oh no, sorry, that's not right. The payout ratio, 1 minus the payout ratio. Where the payout ratio is equal to the dividends divided by the earnings for the firm. Or another way to write that is the dividends per share divided by the earnings per share. 1 minus the payout ratio is also referred to as the retention rate. It's denoted with a B and is equal to 1 minus the payout ratio. Oops. And so now we'll actually get to the retention growth rate. Oh, actually, I'm sorry, I already did. So the growth rate is equal to ROE multiplied by the payout ratio, 1 minus the payout ratio, or ROE multiplied by the retention rate. The idea being here is that if I earn a certain return on every dollar of equity, book value of equity that I have, and I reinvest those dollars back into the firm, I should be able to generate the same return on those reinvested dollars, and that's going to be my growth rate. That's where my growth is going to come from. So the proportion of dollars that I retain back into the company is going to dictate the growth of the company. The greater the value of B, the greater the sustainable growth rate. Okay? So if my B is equal to 1, meaning I don't pay out any dividends, I'm going to have a growth rate in theory equal to the ROE. One caveat to this, and I had this come up with some research that I was doing with someone else, where this was, a little more complicated form of this was used, but this was essentially used as the growth rate for firms. The problem being is that you can get a really incredibly high growth rate from the ROE itself. But what that didn't take into consideration is that there may not be consumers out there, that many more consumers that want your product. Okay, so the growth rate, the long-term growth rate, I should say, is limited by the population demand for the product or service of the firm. Okay, so in this example that I was talking about, it was hospitals. So we were getting growth rates of like 15 and 20% a year. Okay, people don't want to go to the hospital that much. In the end, what limits the growth rate of a hospital is the population of the community. Is that population growing? Well, okay, if it is, then it's likely that there'll be increased demand for hospital usage. But if the population's shrinking, you're not going to get those really high growth rates. Or if it's just staying stable, you're not going to get those growth rates. So there is a limit to the growth rate to a firm that is not internally driven. Okay, so this idea here is that it's internally driven, and as long as the firm has not saturated its market, if there's more business for it out there to chase after, more demand for it to chase after, then it can grow at this rate. But this is a maximum, okay, maximum sustainable growth rate. The last one is the analyst forecast. This is the easiest one. We look up what the analyst forecast for the firm. All right. All right, I left a little bit off here. We look up what the analysts for the firm expect the long-term annual growth rate to be for the firm. Okay, let me show you an example of this really quick. Again, I'm going to work through an example of a firm But we'll go to Walmart here, and this is one source of information. There's also other great sources out there. If you live in Shawnee County, you have access to the Shawnee County Library. It has access to Value Line, which is a very well-respected source of investor information. I know individual investors, and by the way, it's not cheap, but I know individual investors who actually get this, sent to them. It's a either monthly or bi-weekly report. Very, very well respected, and it has analyst estimates. I'm showing you the one from Capital IQ, and this is for Walmart. So what I'm going to look for here is here we go, CIQ estimates. So CIQ stands for Capital IQ. Another source is Morningstar. So Morningstar, Value Line, and there are also analyst reports. If you buy and sell your stocks through a brokerage, so for example, I use Ameritrade, not that it's better than any other place. It does have, along with other brokerages, they do have access to research that you can pull up for individual firms. So here we're looking at Walmart and the long-term growth. Here we go, right here. So this is the long-term EPS growth for 5 years. And that's kind of also what Value Line provides. Value Line provides EPS growth, dividend growth, and estimates for that time period. And here it says the median. This is usually what I use. The median growth rate, expected growth rate per year by analysts is 8.02%. Okay, and that's the number I would use for that calculation. So like I said, we're going to come back to all these when I work through the example for the class. The last item, the last approach I'm going to talk to you about, one last thing here. So when we calculate this with the retention growth method, remember these are the growth rates. The historical growth rate, we'll calculate that, the retention growth rate, and the analyst forecast for growth. Those are all growth rates. In each case, we're adding those growth rates to the existing dividend yield for the firm. So just briefly going back to Walmart, I'm going to go out to the tear sheet. Remember the long-term growth rate is 8.02%. I'm going to click on the tear sheet up here. And if I scroll down, it's going to say the dividend yield is 1.5%. So what that means is that if we took the expected dividend for the next year, divided by the price today, we're going to get 1.5%. In terms of like absolute numbers, a 3 to 4%, 3% to 4% dividend yield is considered to be a high dividend yield. Okay. So I'm going to take that 1.5%, add it to the 8.02, and that would give me a required rate of return on the firm's equity of 9.52%. 9.52%. So that would be one of my estimates here, if I were to use that as the required rate of return, is the dividend yield plus the growth rate. So now we're going to go into the last approach we're going to talk about with calculating the required rate of return on equity. And that's the capital asset pricing model. So the premise behind the capital asset pricing model is that investors are rational and risk averse. The risk of a firm are either firm specific or market risk. And these are also referred to as unsystematic, that's how we'll often refer to as firm specific risk, or systematic. So a firm-specific risk is a risk that will only affect one or a handful of firms. Firm-specific risks usually revolve around either managerial issues or product issues. There are other exceptions to this, things like regulations. are often firm-specific risks. So the cancellation of the Keystone XL pipeline, that's more of a firm-specific risk than it is a market risk. So it's going to directly impact those firms that were investing in that pipeline. Okay? You can think of different regulations that affect different industries. Right now, man, a big one for the financial services industry is this idea that financial advisors are supposed to indicate whether or not, and be upfront with their customers, whether or not they are fiduciaries and acting in a fiduciary responsibility. And the regulation is currently kind of up in the air. It was set to go in place during the last presidential administration, but then it was canceled. What it said was that financial advisors have to tell their clients whether or not they receive commissions on the products that they're recommending for those clients. So, and I'm about to go down a rabbit trail. I'm trying to avoid it. If you go to, and I'm not picking on any one of them, they all kind of work the same. An Edward Jones or a Mutual of Omaha or one of those types of companies where you interact with a financial advisor, those are commission-based advisors. So they earn commissions from the products they get you to sign up for. Okay. The requirement is currently that those don't have to be the best products for you. Okay, they don't have to be the best investments for you, but they do have to be suitable. So they have to tell you, according to this regulation that hasn't been put in place yet, they would have to tell you if they receive a commission for selling you that product, and that it is exactly what I just said, that the product may not be, or the investment may not be the best for you, but it is a suitable investment. Okay. That there's a lot of contention with this, because if I'm a client and I'm sitting there and you're telling me, oh, I'm recommending this investment, and by the way, I get paid a commission for it, and by the way, it's a suitable investment but may not be the best investment for you, I may not want to engage with that advisor anymore. So it is controversial, and it is going, if it goes through, it will affect a handful of firms, not the market in general, but an industry it will certainly affect. So these firm-specific risks are usually related to managerial or product issues. A good example of this, if you remember Volkswagen, I believe it was back in 2015. What was happening was that it was the diesel Volkswagens were taught or programmed to cheat emissions tests. And so as a result, Volkswagen in the United States had to recall all of their diesel engine vehicles, and virtually overnight, within a few days, the company of Volkswagen lost 1/3 of its market value. I mean, it was a huge deal for that company, where they had to recall so many cars, and they couldn't sell them because they didn't meet the emission requirements. So that is a product-related issue and a managerial issue that it had an extreme impact on a single company. Didn't hurt Ford, didn't hurt GM, didn't hurt Toyota, didn't hurt any other car company other than Volkswagen. Okay? So those would be examples of a firm-specific risk. A market risk is a risk that affects most, if not all, firms in the marketplace. So, a recent example of this would be a global pandemic. This has affected, again, most, if not all, firms in the marketplace in some manner. So some companies will do better. Zoom, for example, probably is doing a little better these days than prior to the pandemic, but most companies are going to be hurt by this. But the idea here is that it affects most, if not all, companies in a specific way. I mean, in a real way. Global pandemic, more common ones are interest rates. Oops. I apologize. Here we go. Sometimes I have to look down at my hands to remember where my fingers are. Inflation rates, unemployment rates, fuel prices. These are things that affect most companies. And sometimes when I ask the class, can you give me examples, I'll get the answer of regulations. Actually, regulations tend not to be market risk because regulations tend to be tied to a specific industry. Okay. So, for example, I'm trying to think of an easy one here. Regulations on water quality probably wouldn't have a big effect on General Motors. Okay. It's not going to be a meaningful effect for that company unless they do a lot of dumping in waterways. That's going to hurt the firm if the regulations go into effect. But assuming they don't, it's not a market. It's not a relevant risk for the company to be concerned about. So when interest rates rise, interest rates a great example here. When interest rates rise, the stock prices for most firms fall. Okay, when interest rates decrease, the stock prices of most firms increase. And that's related to several things that go on with firms. So if interest rates decrease, those firms can borrow at a lower rate and as a result pay less in interest expense. If they lend, if you've got like a car dealer, when interest rates go down, the rates charged on loans for cars also go down, and car dealers sell more cars. And so lower interest rates help out a lot of firms. On the other hand, it's not great for banks. Low interest rates aren't really that great for banks. So again, it's a risk that affects most firms. But the key here is, and one of the problems with the capital asset pricing model is that it does not affect all firms in the same way. Okay, we're going to talk more about that later. But the idea behind the capital asset pricing model is that investors can eliminate most firm-specific risks through diversification. So when we think about diversification, think about purchasing the S&P 500 index. The S&P 500 index is an index of the 500 largest firms by market capitalization in the U.S. markets. If I buy that index, I'm buying the stock of 500 different firms. By buying a share, it's an exchange traded fund. So if I buy a share of the S&P 500 index, I'm buying a little teeny tiny portion of 500 different stocks. That is extremely diversified. So the idea here is that investors can eliminate most firm-specific risks through diversification. So according to the CAPM, only market risk should be compensated because rational investors will diversify away the firm-specific risk. And so firm-specific risk should not be compensated with additional return. Market risk is measured using the firm's beta. So you'll see it either designated as a small b or the Greek symbol for beta. It is the beta for the firm is the coefficient. I'm going to use some technical jargon here. So the beta is the regression coefficient that is taken from a regression of, a regression of the individual firm's returns on the individual on the returns for a market proxy. So we would take the returns for the S&P 500, for example, and we create a regression, and that would be the beta, the coefficient on the return for the market. So it explains the relationship between the firm, the returns for a firm and the returns for a market using historic prices and historic returns. So what is the capital asset pricing model? The capital asset pricing model, again, just to kind of reiterate, it is a hypothetical approach to determining or determine the required rate of return on a firm's common equity based on the firm's sensitivity to market risks. Okay. Again, we eliminate firm-specific risks through diversification. The only relevant risk is the market risk. If the firm has lower than average sensitivity to market risks, the beta will be less than 1. If the firm has average sensitivity to market risks, the beta is equal to 1. If the firm has lower than average sensitivity to market risks, the beta is less than 1. In theory, we can have negative betas. In actuality, we don't see that happen very often. And you know, if you think about it, you know, the beta describes the relationship between the returns for the firm and the returns of the market. We know over long periods of time, the market prices, the value of firms in the stock market, go up. So if we had a firm that had a beta that was negative and that was consistent over time, that means the value of the firm or the value of the investment would be going down. And there's only, you know, there's a lower limit to what the price of an asset can be. That's 0. So eventually, that if we had firms that had consistently negative betas for long periods of time, the value of that firm would be 0 and the firm would just go away. It would be bankrupt, or you know, if it's another asset, it would just not have any value to an investor. So that's why we rarely see negative betas. Sometimes we see them over short periods of time for things like gold. Gold usually has a pretty low beta. It's not really doesn't go with the stock market. So for firms that are likely to have high betas are cyclical firms, meaning that their returns increase more during good times and decrease more during bad times than the average firm. These are often firms that produce luxury products. So companies like Tiffany, I don't think Mercedes-Benz is publicly traded anymore. I mentioned one earlier. I'm still thinking about the previous lecture I recorded for this class. I talked about VF Corp. They're a luxury brand. They sell luxury brands, so I would expect them to have a high beta. They do well when times are good. They don't do well when times are bad. They do really poorly when times are bad. So cyclical firms and firms with high betas are often firms that produce luxury products. They do good in good times. They do really bad in bad times. That would be the main example of a firm with a high beta. Banks also, and financial institutions also have high betas. Because if you think about it, banks do well when businesses are doing well. If the economy is doing well and things are going great, then what happens is that, those companies want to expand. When they want to expand, they go to a bank to borrow money. And that's how banks make money, is they lend out money that depositors have provided. And so they tend to be cyclical. They tend to have high betas. What are some examples of firms that are likely to have low betas? So these would be your firms that do well during recessions. They're counter-cyclical or non-cyclical firms. Examples of this would be like Dollar General, and I always have a hard time remembering which one went away and which one didn't, or Family Dollar. So kind of your substitute goods tend to have low betas. Gold, it's not a firm, it's an investment, tends to have a low beta. So if you think of a firm that, pay less when it was still a publicly traded firm, likely had a low beta. Let me just look up for a second and show you a couple of examples here. So I'm going to go back out to Yahoo Finance. And one thing to note is that firms with different sites will have different approaches to calculating this. I'm going to show you in the video I'm going to make showing how to calculate this. I'm going to also show you how to calculate the beta. We also have it available through Capital IQ, and it's pretty darn close between the way I'm going to show you and the way that they do it. So here Yahoo Finance actually says they use 5 years of return data, and it's calculated monthly. We don't know what they're using for the market proxy in this case, but for AMC they have a high beta. It's 1.45. You kind of think about it, yeah, when the economy does well, movie theaters tend to do better. It's been a weird situation for a company like that, so I don't want to focus on that one too much. So Dollar General, I said, man, I'm crossing my fingers, hoping that it comes up the way I expect it to, and it did. So the beta here is 0.56, which is much lower than 1. So again, it would indicate that it has a lower than average sensitivity to market risk. Let's say Bank of America, BAC. And I clicked on the wrong one there. Here we go. All right. And I mentioned that banks tend to have higher betas. Here we see that's true for Bank of America. They have a beta of 1.54. So remember, 1 is average. 1.54 would be, considerably above average risk there. And then I'm going to look up, and I'm a little frightened of this one because I've used it as a high beta firm in the past. This is weird. Well, just, I don't know. Yeah, it's not showing me anything here. I think something may have happened to the company. For some reason, that's not showing up. I'll look up one more. VF Corp. The ticker is VFC. We see here. So this is interesting. I mentioned before that maybe it was kind of a higher end brand. It actually has pretty average beta. The Nike out here again, and this one's actually a little lower than average, so it kind of indicates that Nike is a more mature firm out there and is kind of seen as a common company. So that's it. That's what I wanted to show you for this lecture. What we're going to do is hopefully we will not be having issues next week, and we'll have a live lecture. What I plan on doing for next week is finishing up these notes live in class, and then I'm going to provide you with a video of how to calculate the weighted average cost of capital given a set of information. Your assignment then is going to be to do exactly that, is to calculate the required rate of return, the cost of capital for a firm. Okay, so that's it for this time. Please stay warm. Let me know if you have any issues with the video or anything, questions about the topics that I've covered or the notes that I've covered. I know I tend to ramble on a little bit without anyone there looking over me, so I apologize for that. And I will see you next week, if not sooner. Okay.